As an insolvency practitioner, I'm often asked by people to explain what insolvency means. And I didn't know myself when I first started doing this over 20 years ago. Never heard the term. The definition of insolvency is actually determined in section 123 of the Insolvency Act 1986. And it effectively says there are 3 tests, and you only need to tick one of those to actually be deemed insolvent. The first is if your limited company has received a statutory demand for £750 or more, and the 3 weeks prescribed period has passed and you've not been able to satisfy and pay that debt. The second is if you've got an outstanding CCJ or county court judgment that hasn't been paid. The third is if you can prove to the satisfaction of the court that your balance sheet is negative. And as I say, you only need to prove one of those to satisfy the court formally that the company is insolvent. But actually, if you look at the bigger picture, it's really when a company is unable to pay its debts as and when they fall due. So examples may be perhaps you're having a problem paying your creditors. So you maybe got terminal issues with the bank account, often at its limit and overdrawn. Perhaps you've got bad debtors and actually they're aging debtors. Customers haven't paid their debts and that problem is getting worse and worse. Those debts are getting older and older and harder to collect. Perhaps you've got significant cash flow problems, continually having to put one creditor off because you've got to pay another one. You just simply don't have enough cash. And quite often people will actually say to me, oh, I'm not insolvent. We've got money in the bank account. For example, we've got £20,000 in our bank account. Well, that's fine. But if you've got £200,000 of creditors and £20,000 in your bank account and no other material assets, then actually you are insolvent. How are you going to pay all of those debts back? If you've got late payments or overdue payments to creditors, that's an obvious sign that the company is struggling. Perhaps it's been making profits in the past. Now those profits are getting smaller or dwindling. Perhaps you're not on top of your financial figures. You're not producing regular management accounts. You're relying on the company formal accounts that are done annually. They're really out of date because they're done at the end of the company's financial year and they have to be produced within 9 months of that year end. So by the time you get them, that information is so out of date. Ideally, in the perfect world, a company would have regular management accounts, perhaps monthly, and be constantly looking at their figures. Although I appreciate sometimes a company can't afford to pay that, sometimes you can't afford not to do that because you need to be able to keep an eye on the company's cash flows and its position and your predictions. If you've got a cash flow forecast, and just to keep an eye on it, and then you can plan for things and you can do a move around and perhaps take early insolvency advice if there are some warning signs there and some problems, so that you can avoid perhaps being forced to go into liquidation. Perhaps things can be turned around or a rescue can be implemented. It's kind of considered a bit of a joke in the insolvency industry that we'll often get calls from directors saying that they're unable to pay their staff's wages. And it's happened to me recently. It's a joke because it's true. A director called me on a Tuesday and the monthly wages were due on the Friday. And so that's not something that's happened overnight. That's something that's built up, and they've probably known about it at the very least at the beginning of the month. They must have been worried that unless they get X, Y, and Z in place, they're not going to have enough funds to pay those wages. So it's vital that if you have problems, you seek advice from a licensed insolvency practitioner like myself and get that advice early, because even if there is going to be an insolvency process, and even if that means the government can pick up the ticket for the employees, that takes weeks, maybe even months. And the employees are going to be waiting for that money all of that time. So please don't leave it to the last minute, because also leaving it to the last minute means any potential rescues that we could have done or some plans we could have implemented to buy time have effectively been lost, and that's the end of it. So formal definition of insolvency: unsatisfied CCJ, unsatisfied statutory demand, and a negative balance sheet. But actually, in the real world, are you struggling to pay your debts on time? Are you stressing? Are you worried? Are you having sleepless nights? Are there problems? Is the bank account overdrawn? Are you being asked to give personal guarantees? Are you borrowing from family and friends and to try to plug the gap? The key is, as soon as those warnings start to happen, And it may be slow, it doesn't happen overnight, but eventually there will be a straw that's going to break the camel's back. And ideally, take advice before it gets to that stage. Speak to your accountant, take advice from them, and if necessary, speak to an insolvency practitioner. Usually, from my case anyway, our initial meeting is free and it's no obligation and confidential. So it's worth just having a chat, pick up the phone and speak to somebody and get some advice. Please don't bury your head in the sand and hope that it will all go away, because unfortunately it won't. And what you want to do is avoid me. We want to do whatever we can so that you don't end up in front of an insolvency practitioner and you don't end up liquidating your business, unless that's a necessary evil. And if that is, obviously we can deal with that then. But if it isn't, let's see what we can do to help you avoid it.